Preparing for a FP&A at SPAR interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean, and how would you add value at SPAR? FP&A combines financial planning, forecasting, budgeting, and performance analysis to support management decisions. At SPAR, I would connect store, wholesale, and group results to drivers such as sales volume, margin, labor, rent, and shrink. My role would be more than reporting variances. I'd explain what changed, why it changed, whether it is temporary, and what action management should take. That turns financial information into practical operating decisions. While answering, focus on planning, forecasting, budgeting, performance analysis, business partnering, and translating store, wholesale, and group financial data into practical operating decisions. Question 2. How would you build an annual budget for SPAR? I would begin with the prior year's actual results, normalize unusual items, and establish a realistic baseline. Then I would build assumptions for like sales, new stores, product mix, gross margin, labor, rent, utilities, shrink, and capital expenditure. I would validate those assumptions with operating managers, challenge unsupported optimism, and consolidate individual plans into a group budget. Finally, I would document assumptions, secure approval, and establish monthly tracking against the approved plan. Make sure to cover historical performance, operational assumptions, sales and margin drivers, labor and occupancy costs, capital expenditure, stakeholder challenge, consolidation, and formal approval. Question 3. What is the difference between a budget, forecast, and outlook? A budget is the formally approved financial plan for a defined period and provides the accountability baseline. A forecast updates expected full-year results using current performance and revised assumptions, while an outlook is often a shorter-term or directional view used for emerging decisions. At SPAR, I would compare actual results with budget for accountability, refresh the forecast when trading conditions change, and use the outlook to highlight immediate risks or opportunities. In your answer, distinguish the fixed planning baseline from updated expectations and short-term views, while explaining how each supports accountability, resource allocation, and management decisions. Question 4. How would you forecast sales for a SPAR store or region? I would forecast sales by separating like-for-like performance from network changes. For existing stores, I would analyze customer traffic, average basket, product mix, promotions, seasonality, holidays, inflation, and local competition. I would model openings, closures, and ramp-up curves separately rather than blending them into one growth rate. I would then compare the model with regional manager input and recent trading data, documenting assumptions so the forecast can be challenged and updated. Be sure to mention like-for-like growth, store openings and closures, customer traffic, basket size, seasonality, promotions, inflation, calendar effects, and triangulation with operational stakeholders. Question 5. What are the most important KPIs for a retail FP&A team? I would prioritize KPIs that explain both growth and profitability. These include total sales, like-for-like sales, transactions, average basket, gross margin, labor cost percentage, sales per labor hour, shrink, inventory days, operating expenses, EBITDA, and cash conversion. I would also compare performance by store, region, format, and channel. A strong dashboard should not simply show outcomes. It should connect each KPI to an operational lever management can influence. Focus on sales, like-for-like growth, gross margin, transaction volume, basket size, labor productivity, shrink, inventory, expenses, EBITDA, cash conversion, and appropriate store-level comparisons. Question 6. How do you analyze a favorable or unfavorable variance? I start by quantifying the variance and ranking its material components. For sales, I separate price, volume, mix, timing, and currency where relevant. For costs, I examine rate, usage, headcount, and timing. I validate the explanation with the responsible manager and supporting data rather than accepting a generic comment. Then I assess whether the issue is recurring, estimate its full-year impact, and recommend a corrective action or forecast adjustment. In your answer, describe quantifying the variance, decomposing it into price, volume, mix, timing, and rate effects, validating causes, assessing persistence, and recommending action. Question 7. How would you investigate a decline in gross margin at SPAR? I would first split the margin movement between sales mix, purchase cost, selling price, promotions, markdowns, waste, and shrink. I would compare categories, stores, suppliers, and periods to identify concentration. For example, lower margin may reflect a deliberate promotion, but persistent pressure could indicate supplier inflation or weak pricing discipline. I would quantify each driver, discuss actions with buying and operations teams, and update the forecast if the pressure appears structural. Make sure to cover product mix, promotional activity, supplier pricing, retail pricing, markdowns, waste, shrink, distribution costs, and the distinction between temporary and structural margin pressure. Question 8. How would you prepare a monthly management reporting pack? I would begin by reconciling the underlying actuals to the general ledger and confirming consistent KPI definitions. The pack would lead with an executive summary, followed by sales, margin, operating costs, EBITDA, cash, and relevant store or regional metrics. I would explain material variances with quantified drivers, distinguish one-off items from recurring trends, and highlight forecast changes, risks, and actions. The objective is a concise decision tool, not a data dump. Discuss data integrity, executive summaries, actual versus budget analysis, KPIs, forecast changes, commentary, risks, actions, consistent definitions, and tailoring detail to management needs. Question 9. What is a rolling forecast, and when would you use one? A rolling forecast continuously extends the planning horizon, such as maintaining the next 12 months every month or quarter. It helps SPAR respond to changing sales trends, supplier costs, inflation, labor conditions, and store openings without waiting for the next annual budget cycle. I would update key drivers, preserve a clear audit trail, and compare forecast versions. The annual budget would still provide accountability, while the rolling forecast would support current decisions. While answering, explain continuous updating, forecast horizon, driver-based assumptions, improved responsiveness, governance requirements, and why rolling forecasts complement rather than replace annual budgets. Question 10. How would you evaluate whether a new SPAR store is financially viable? I would build a store-level model covering fit-out and equipment costs, opening timing, sales ramp, gross margin, labor, rent, utilities, shrink, distribution, working capital, and maintenance capital. I would assess EBITDA, cash flow, payback, NPV, and IRR, while testing downside cases for slower traffic, lower margin, or cost inflation. I would also consider cannibalization of nearby stores and strategic location benefits before recommending approval. Be sure to mention investment cost, sales ramp, gross margin, operating expenses, working capital, cannibalization, payback, NPV, IRR, sensitivities, and strategic considerations. Question 11. How would you model the financial impact of a promotion? I would compare expected promotional sales with a credible baseline, then model the discount, incremental volume, product mix, supplier funding, and any basket size uplift. I would allow for cannibalization of non-promoted products, forward buying, waste, and operational costs. The key output is incremental contribution, not simply revenue growth. Afterward, I would compare actual results with the estimate and identify whether the promotion generated profitable volume or only shifted timing. Focus on baseline sales, incremental volume, price reduction, product margin, cannibalization, basket effects, supplier funding, waste, customer retention, and post-promotion evaluation. Question 12. How do you approach headcount and labor cost forecasting? I would forecast labor from operational drivers rather than applying a simple percentage to sales. That means modeling store hours, staffing requirements, approved positions, vacancies, pay rates, overtime, seasonal hires, benefits, and productivity. I would compare labor hours with transactions or sales to distinguish volume-driven staffing from inefficiency. I would review assumptions with operations and HR, then monitor actual hours, wage rates, and payroll timing monthly. In your answer, cover approved positions, vacancies, pay rates, overtime, productivity, store hours, sales volume, seasonal hiring, payroll timing, and operational ownership. Question 13. How would you build a cash flow forecast for SPAR? I would start with operating profit and convert it to cash by forecasting inventory, payables, receivables, taxes, and other working capital movements. I would add capital expenditure, lease or financing flows, dividends, and other significant cash items. Retail seasonality and supplier payment terms would be important assumptions. I would reconcile the opening cash balance, identify minimum liquidity needs, and run downside scenarios for weaker sales, higher inventory, or delayed collections. Make sure to cover operating profit, working capital, inventory, supplier terms, receivables, taxes, capital expenditure, financing, seasonality, liquidity buffers, and scenario analysis. Question 14. What would you do if actual results contradicted your forecast? I would not immediately overwrite the forecast based on one unexpected result. First, I would confirm data quality and determine whether the variance reflects timing, seasonality, an isolated event, or a flawed assumption. I would speak with the relevant business owners, quantify the full-year implication, and communicate the risk clearly. If the evidence supports a genuine change, I would update the forecast, explain the bridge, and record the lesson for future cycles. Discuss staying objective, validating data, identifying assumption error, separating timing from structural change, communicating quickly, updating the forecast, and improving the forecasting process. Question 15. How would you explain financial results to a non-finance manager? I would lead with the business outcome, then explain the few operational drivers that caused it. For example, I might say sales were below plan because transactions fell in 2 regions, while margin held due to favorable mix. I would avoid accounting jargon, use a simple bridge or chart, and connect the result to an action such as adjusting labor or reviewing promotions. I would confirm understanding and invite operational context. Focus on plain language, operational drivers, materiality, visual storytelling, implications, recommended actions, listening, and adapting detail to the manager's responsibilities. Question 16. Which Excel skills are important for an FP&A analyst? I use Excel to build transparent, controlled models rather than complicated spreadsheets that only one person understands. Important tools include SUMIFs, XLOOKUP, index match, pivot tables, scenario switches, data validation, error checks, and concise charts. I also value Power Query for repeatable data preparation. Every model should have clear inputs, calculations, outputs, and documented assumptions. I would prioritize accuracy, usability, and reviewability over unnecessary formula complexity. Be sure to mention structured models, SUMIFs, XLOOKUP, index match, pivot tables, scenario analysis, data validation, error checks, charts, Power Query, and transparent documentation. Question 17. How would you improve a manual reporting process? I would map the current process from source data through final report, documenting timing, manual adjustments, controls, and pain points. Then I would standardize data definitions, remove duplicate inputs, and automate repeatable transformations using Power Query, a reporting tool, or controlled templates. I would test the new output against prior periods, retain reconciliation checks, and document ownership. Success would mean fewer errors, faster close reporting, and more analyst time for insight. In your answer, describe mapping the current process, identifying control risks, standardizing sources, automating repeatable steps, testing outputs, documenting ownership, and measuring time saved. Question 18. Tell me about a time you found an error in financial reporting. In one reporting cycle, I noticed a cost ratio moved sharply despite stable operational activity. I traced the issue to a duplicated invoice extract, confirmed the amount with accounts payable, and quantified the impact on regional EBITDA. I informed my manager promptly, corrected the report before distribution, and added a duplicate check control to the process. I also documented the root cause and briefed the team so the improvement became part of normal reporting. Make sure to present a clear situation, investigation, root cause, quantified impact, communication approach, corrective action, control improvement, and evidence of professional judgment. Question 19. How would you prioritize competing requests from senior stakeholders? I would assess each request by decision impact, deadline, urgency, effort, and dependency on other work. A forecast issue affecting a major investment or liquidity decision would generally outrank a routine analysis. I would confirm the required output and level of precision, communicate realistic timings, and provide an interim view when useful. If priorities conflict, I would escalate with clear options rather than silently missing deadlines or compromising accuracy. Discuss urgency, decision impact, deadlines, dependencies, data availability, transparent communication, expectation management, and escalating conflicts when priorities cannot be reconciled. Question 20. Why do you want to join SPAR as an FP&A analyst? I'm attracted to SPAR because its retail and wholesale environment offers a direct connection between financial analysis and daily operating decisions. Store traffic, product mix, promotions, labor, and supply chain choices create measurable financial outcomes, which is exactly the type of business partnership I enjoy. I would bring strong analytical discipline, attention to detail, and clear communication, while learning the business deeply enough to turn reporting into practical recommendations for sustainable performance. Be sure to connect SPAR's retail and wholesale environment with your analytical strengths, commercial curiosity, stakeholder skills, learning goals, and motivation to influence operational performance. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.